Looking for more investing options? Meet Cboe, the exchange that pioneered options trading. With exclusive trading products like VIX and SPX options, Cboe can help you trade in any market environment. There are risks associated with Cboe Company products. Review the disclosures and disclaimers at cboe.com/US_disclaimers.
The views expressed on this podcast are those of the participants, not of Reuters News.
If there's one thing Hollywood loves, it's a sequel. Indeed, the storied Warner Brothers movie and television studio has spawned a veritable M&A franchise. Whether it was magazine operator Time, dot-com bubble star AOL, stodgy telecom giant AT&T, or cable network operator Discovery, many suitors have found the age-old media company impossible to resist and ultimately impossible to live with. In its latest corporate incarnation, known as Warner Brothers Discovery, it has inked what it hopes will be the next blockbuster installment in the series, agreeing to sell most of itself to streaming giant Netflix for $83 billion. The only problem? Another Tinseltown titan is trying to bust up the proceedings with a $108 billion offer. What all this drama means and what audiences can expect to see is the focus of this week's Newsroom. It's Amy.
And it's Jonathan. And this is The Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with breaking views columnists about the knottiest issues in business, corporate finance, and economics. Amy, just reading through that history, it's sort of hard to believe that yet another media giant is willing to drink from what might seem, given emphatically repeated experience, to be a poisoned chalice, right?
Absolutely.
Going through that list, like the remnants of Time were eventually spun back out, then acquired by rival Meredith. AOL was cut loose and through a series of deals ended up being scooped up by this Italian tech roll-up. AT&T announced the unwinding of its deal less than 3 years after it closed, and Warner Bros. Discovery stock has collapsed basically as soon as it was formed by the last merger. It feels like, kind of like the one and only iron law of M&A is that acquiring Warner is just a really, really bad idea. And yet we have a fight for it. We have Netflix on the one hand and Paramount Skydance on the other, who have both put these gigantic bids on the table for the home of HBO and all these other prize assets.
Yes, they seem to think that there will be a happy ending. At this time, there will be a happy ending for them. So yes, as you said, a mere days after the Warner Brothers Netflix tie-up was announced, Paramount decided to gate crash with its own hostile offer. But I think one of the interesting things, I suppose, from our point of view and for breaking views is, right, fees. We've had this M&A kind of desert for a long time now. And here is two companies vying tens of billions of dollars to get this deal over the line. So, I mean, I guess if you're an M&A banker, you're pretty pleased with this situation.
Exactly. Like, you're more than happy to roll out the red carpet for anybody who wants to try and get involved in this situation, especially as the price tag looks like it might be going up. So I think maybe we should bring in our guest this week to help walk us through what exactly is happening here. We're joined today by Jennifer Saber, Breaking View's chief media watcher, and Stephen Gandel, who covers deal makers for us here in New York. Jen, Stephen, you're very welcome to the Viewsroom.
Hi.
Lovely to be here.
So, Jen, we kind of gave like a little capsule version of the history
a
there.
trailer, Jonathan, a trailer.
Yes, that's right. Sorry. Why don't you bring us up to date on the latest installment? Like, what is going on? Like, who are the personalities involved this time around? And what is everybody angling for here?
Oh my gosh. Well, I just have to say, I am so excited that this has dropped in my lap. I mean, we've had a dearth of deals, as you said, Amy, that are exciting or fun to watch. Last time there was anything of this kind of caliber was when Disney was buying Fox and was competing with Comcast. And that was 7 or 8 years ago. So here we are again in Hollywood, and never, ever underestimate egos in Hollywood. It's a special breed. And so that is, I think, what is at play here. So we have David Zaslav, who is head of Warner Brothers Discovery. He loves Hollywood, loves it. He went off when he acquired this company and went and bought Robert Evans' estate in LA. He dusted off Jack Warner's desk and is sitting at it. So this guy just loves it. And then on the other side, you have David Ellison, who just picked up Paramount, which is CBS, the studio. etc. And he's a newbie. He kind of came out of nowhere. He had a studio, but it was kind of a small fry studio. I mean, I'm sorry to say it, Skydance. They did great work, but now he's in the big leagues. And then you have Ted Sarandos and Greg Peters, who are the co-CEOs of Netflix, who really they're the most shocking characters in this entire tale, which I can get to later, but they typically do not do deals at all. And if they do, it was like 700 million. So this is like way out of their orbit.
I mean, listening to you, Jen, which I think that is so well explained, why on earth, given what Jonathan has laid out and what I laid out in terms of like the track record of this industry, why would you think this would be a good idea? And how on earth do you sell this to shareholders?
So if I'm sitting here and like putting on my banker hat or chief executive hat, and I'm trying to like make a rational argument for why you would want this. If I'm Paramount, Paramount is, they're just not that big. Paramount streaming is maybe in fourth or fifth place. I don't know. They're one of the laggards. CBS is a great broadcast studio, but it's traditional TV. They have a good movie studio, but it's not that big. So if I'm David Ellison and I have, the backing of my father, who is Oracle co-founder and the last I saw the world's fourth richest man, Larry Ellison, I'm like, I'm just going to get bigger, right? And so for the strategic rationale makes sense for them to an extent. Of course, as you have laid out, getting bigger is never usually an answer for these things. Netflix to me is a complete mystery. And what I mean by that is they are a company that was founded in 1997. Remember that. Like I'm stunned that they've been around this long, and they have never done a big deal. They have always built their business or transformed their business. And for them, this Warner Brothers deal, what it gets them is a studio and content, which is important. Don't misunderstand me, but HBO, they don't really need HBO. They have subscribers that are duplicates, really. Um, they don't really need the streaming subscribers. They don't, so it's kind of, yeah, I mean, the content's great, but it's just they're paying an awful lot of money for that. So, again, I go back to what I said at the beginning of this, which is do not underestimate ego in these types of deals.
Right. And I mean, I guess also don't underestimate maybe somewhat motivated advice. Because I look at, I look at this on the other side of the fence, which is all of the bankers who are like crowding around this, right? And this is just huge numbers that everybody is throwing around. Like Netflix would be taking out a colossal, like $59 billion loan to back its bid. Paramount's looking at, I think it was like $54 billion of debt, including involvement from like Apollo on like a private credit slice and, kind of like sovereign wealth money from the Gulf and all this kind of stuff. Like, Stephen, can you just help us like contextualize that a bit and what it means? Because banks have been on the losing end of M&A and financing deals for a while now, right? And I mean, that's not like a small shift. That's something that's like really affected banks' earnings and valuations and so on, right?
Right, but a really big thing has happened to the economy and also bank regulation, and that's Trump, right? I mean, the Trump administration wants to deregulate banks and allow them to do higher leverage loans and allow them to use their capital, right? And so that has unlocked a lot of money. I mean, and I don't know whether you view this deal as wise or unwise, but it's definitely going to unlock the ability for companies to do sometimes unwise deals. And so there's about the big banks have about $7 trillion in risk-weighted assets. And the estimate is the lower regulations, the new capital rules, the relaxing is going to allow them to increase the amount of capital used by about 10%. So we're talking about 600.
Hold on a second, Stephen. We're going to have to do a little jargon alert here. So you're going to have to deconstruct that all for Jonathan's dad, who listens to our podcast.
Okay.
So start with the risk-weighted assets. Why is this important in terms of deregulation?
Banks have a certain amount of risk-weighted assets, and then they have to hold a certain amount of capital against those assets, because those are loans or securities or investments they're making. And if they were to lose money, then they'd be losing their depositors' money. And so regulations make them hold on to a certain amount. And the Trump administration and the banks have been arguing for a while that ever since the financial crisis, we've been too restrictive. We're forcing them to hold on to, meaning not leverage up too much of their assets. And so that's held them back from financing these big deals. Other firms have, other private credits and other investment firms have come in and provided some capital. But to do some of these really big M&A deals that we haven't seen for a while and we're seeing come back now, you really need some of the larger balance sheets. That's the big banks. And so the estimate is that through a bunch of different things the Trump administration is going to do, they're going to lower capital requirements by something like 10%. That's an extra $600-700 billion that banks can lend. The other thing going on in Wells Fargo is that they have been recently out of their kind of shackles. They've been in trouble with the Fed for a while, ever since the double account scandal. And so they now have a lot of room to use capital. And so these numbers sound big, but it might just be the tip of the iceberg of what the banks have enabled to deploy into this new kind of regulatory environment, which not just for the banks, but also for everyone, is going to be more accommodating to large mergers.
Right. And that's Wells Fargo, which is supporting the Netflix side of that bid, right? And then when you look over at the Paramount side, I think like what that also makes clear is this isn't just banks, right? Because Jen, I think they're getting like big support. You know, you mentioned like this Ellison family money that's been boosted by like the crazy AI boom. And then there's also a bunch of kind of like sovereign money coming in behind that as well, right?
Yeah, I mean, look, there's the bid for that Paramount has put out is roughly about $108 billion, right? Which that's a lot of money. And just to kind of go back to something that you said, Jonathan, about debt. Debt is what has gotten these companies into trouble in the first place. That is why Warner Brothers Discovery is largely kind of, shackled, is because they larded a ton of debt when they bought this from AT&T. AT&T bought Time Warner. They had a ton of debt on their books. So, like, it's a merry-go-round of, I don't know how you want to describe it. It's like the same story that keeps going on again and again and again. So, yeah, do they have the capital? Sure. Are they, tapping the Saudis and other Middle Eastern sovereign wealth funds? Yes. Is that going to be an issue? That is actually a big question. I don't know. And there is something special about Paramount, which is they own CBS, which is a national broadcast station. There are very specific rules about foreign ownership with national broadcast stations, and I'm not quite sure if they meet the threshold for that or not. But that's like one question, and to kind of think about, they said that it sort of clears the other regulatory body that checks into these kind of foreign transactions. I won't, I hate this word, but CFIUS. So, but let's just say the body out of the Treasury Department that has oversight on this. They say that it's not a problem. So we'll see.
And Jen, I was kind of curious about this because, as Stephen very nicely set out, that the banks now are somewhat unshackled in terms of like the debt that they can provide. But similarly, there does seem to be like an easing of the ideas of competition, as in terms of M&A deals that can happen. Is this the kind of deal that would be open to scrutiny in terms of competition, just given how big these companies are?
In normal times, yes. So basically, you have Paramount, which is, again, it's a much smaller company, but they have a broadcast station. They have a streaming unit. They also, critically, they have a studio already. So all these could be issues. Netflix is the largest streaming player in the United States for sure. And, HBO is pretty big too. So if you look back at other deals that traditionally have been blocked, like say when AT&T, which, was trying to buy T-Mobile, that was blocked because it was like, it was a combination that was going to make them too big. So you could maybe make that argument with Netflix. But again, it all comes down to how you define the market. And critically, it all comes down to what President Donald Trump, what he wants, because he has said he's going to be involved in this.
The banks are eager to deploy this capital. I mean, even though the economy has been so good, bank lending has kind of been weak, and that's in part because a lot of this financing has moved outside of the regulated banking industry. If you just look at the last quarter, all loans in all different categories, housing loans, auto loans, all categories, it rose by $100 billion for the entire banking sector. And here we're talking about, depending on which one does a merger here, we're talking about $45, $50 billion, right? They are eager, and C&I lending is actually down. And if you look at where big lending can come from, these deals are where banks can see the big growth in lending that they're now allowed to do and want to do. And so I think that's adding fuel to the fire.
So obviously before anybody's silver screen dreams are realized here, whether on the banking side or the company side, we have to get through this hostile bid situation, right? So we have an agreed deal with Netflix. We have Paramount launching a tender offer, taking its all-cash offer for the entire company, like direct to shareholders. I think it's important to make that distinction, right? Because the Netflix deal would still leave this sort of stub company of cable networks kind of trading separately, and it's a big question over how much that is worth. So, I mean, just in like the immediate term here, Jen, what should we expect to see next?
Well, I mean, that's a great question, and it's on everybody's mind. I was at a Christmas party at a certain media company last night, and that is all that anybody talked about. That was the chatter. And I think the prevailing wisdom is this is going to be a long, drawn-out battle. And effectively, what is going to happen is, what do Warner Brothers shareholders want, right? Do you want cash on hand, $30, possibly more? Who knows? This could keep ratcheting up. And, the entire company, or are you want to, stake your claim with Netflix and get a piece of Netflix and see what they do with this, and then, roll the dice on the rump company. So, there's a lot to consider. Like I said, going back, egos are they're gonna keep at this, and there's gonna be, I think, a very long, drawn out fight.
Jonathan, I think Peter Tal Larsen, who runs our division, he once talked about in his newsletter about the fact that, sequels are very rarely better than the original. And I did point out that I thought The Godfather is an exception to that. But it does seem like this sequel, in terms of, if we were to think about that, just in terms of these deals, it does look like it's got all the ingredients to make it a bit of a disaster, but we shall see. And it's exciting for Jen to be able to cover it and for all of us to watch on. So Stephen, Jen, thank you so much.
Thank you for having me.
Thank you.
Thanks for tuning in. This podcast was produced by Cheryl Pena in New York and Gregory Garner in Toronto. You can listen to a new episode of The Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune in to our sister podcast, The Big View, every Tuesday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow The Viewsroom and let us know what you thought. We have a new email address where you can send us feedback, which is breakingviews-podcasts@tr.com. And check out our views on the biggest stories in business and finance every day on breakingviews.com and reuters.com.
Looking for more investing options? Meet Cboe, the exchange that pioneered options trading. With exclusive trading products like VIX and SPX options, Cboe can help you trade in any market environment. There are risks associated with Cboe company products. Review the disclosures and disclaimers at cboe.com/US_disclaimers.